money radio for a really great future. We're talking real money.
Well, I stocked up on questions and answers long enough, and now I've run out, and I have to go back and start doing some, even though I'm still traveling across the country and am in Butte, Montana right now. So we're going to do the Friday Q&A today. I'm Don McDonald, driving across the country, getting ready to meet Tom at Lake Chelan pretty soon, and then spend a few weeks in the Seattle area. And I have questions that you sent in to talkingrealmoney.com. Actually, you spoke them in at talkingrealmoney.com as opposed to type them, which is how we use many of our questions. But on Fridays, I use the ones you called in. And I know I'm a little behind on those because I've been traveling. So please bear with me as I get through them. We'll get through some of those right now on the program. And remember, if you want to call us live, you can do it every Saturday at 855-935-TALK, 855-935-8255, between 3 and 5 p.m. Eastern, noon and 2 Pacific, a time zone that I will be seeing soon. Oh my gosh, everything's going to be too early now, isn't it? All right, let's go to the very first question of the episode.
Don and Tom, I'm a regular listener and even strongly considered Appella Wealth in the past, and I've talked to Tom. Thank you for what you do. I truly appreciate it, and I've learned a lot. I currently have 100% fiduciary managing my wife and my funds. However, they are increasing their AUM fee structure. Since we have $1.9 million of $2.2 million with them, we are currently paying less than 1%. I'm happy with getting the market's annual return as opposed to trying to beat the market. We have enough in pension and Social Security to easily meet our annual or mandatory financial expenses, so I'm considering simplifying our investment management by parting with our advisor, moving from Fidelity to Vanguard, and then putting 40% of our $1.9 million in VTWAX and 60% in BBTLX. We also have $115,000 in brokerage accounts and $103,000 in the TSP. The goal is to take 4 to 4.5% every year and hopefully not exhaust our investments. I'm retired and my wife retires in a month. However, neither is currently receiving Social Security. I'll be full retirement age February 1st, 2025. 66 and 8 months. And my wife will be 62 and 8 months on that date. We currently have $300K in Roths and the rest in tax deferred accounts. Don and Tom, what is the downside to my simplified asset allocation? Thank you very much.
Well, first, let me start by saying we are both believers in individual investors' ability to invest on their own. However, the but comes when you get to the decumulation phase, when you get to the point in life where you are and you have to start taking money out to live for the rest of your life effectively. That's where it becomes less of investing advice and more of financial planning and management and life management and tax management. So can you do it? Yeah, in the simplest of terms, of course you can do it. There's no reason why you couldn't build a reasonably well-diversified portfolio with the total market fund and the total bond market. We talk about it all the time. However, the problem comes when you need to do some more complex tax planning or you need to withdraw at different rates and a lot of other things that can come up along the way. The other one that can come up, and you didn't talk to me much about your risk tolerance, but the other one that could come up is a big downturn in the market. And what are you going to do then? The hand holding is such an important part of the process. Can you do it? Yes. Should you do it? That's the part that's in question. And without knowing a whole lot more about you, your inclination, your future needs, in other words, things a good advisor and planner should know, it's hard to give you any kind of definitive answer, but with a very broad brush, yeah, you probably could pull it off. Thanks for the question. You have questions? Go to talkingrealmoney.com, click on the Contact Us button, and then record your question. Or if you like to call live and actually talk to us, the only time you can do that during one of our episodes is on Saturdays when we record our live show in Seattle. And that's from 3 to 5 Eastern, noon to 2 Pacific. And the phone number is 855-935-TALK, 855-935-8255. And if you hear some weird crunching sound in the background, there's nothing I can do about that. That's the puppy chewing on a bone. And so since I'm in a trailer with the dog, there's no other place to go. Let's go to our next question.
Hello, Don. This is James, and I have a retirement question for you about when or how to take pension benefit amounts. I've got a lot of options. The two I've narrowed it down to are 100% joint and survivor annuity, which pays myself and my wife after my death a fixed amount, or a life annuity with 180 payments, 15-year guarantee, which pays approximately $100 more a month, but is only good for 15 years. I'd like to get your thoughts on which of the two are better. Obviously, no one knows the future or how long they're going to live, but I'd like to get your thoughts because $100 in retirement sometimes can be a big difference.
Sure, it can be a big difference, but I can't answer the question. I really can't. I can, again, dance around it a little bit, give you some thoughts, but without knowing the specifics of those annuity options, I can't comment on them. But I don't like the idea of giving an insurance company your money and then only taking income for 15 years. I mean, the return would have to be pretty much astronomical because remember, with an annuity, an immediate annuity, you're getting your principal back. So, wow, I mean, the checks would have to be huge to be worthwhile. The reason most people get an immediate annuity is for the certainty of it. The certainty of not outliving the money, though, not the certainty of payments over a set period of time. That's not, I don't think that's in your best interest. If you're going to get an annuity, you get it because you really don't want to outlive your money. You don't want you or your wife to outlive the income. And that's what the joint survivor option is going to do for you. It's going to give you that certainty all the way through life. And that's the only reason, in my opinion, the only reason to ever buy any kind of annuity. It's for certainty in retirement so you don't worry about outliving your income stream. Otherwise, there's no point in having an annuity, in my opinion. Thank you so much for the call or the question or whatever we call it, because you actually didn't call. You went to talkingrealmoney.com, you clicked on the contact form, and then you recorded your question. But you can call every Saturday from noon to 2 Pacific time, 3 to 5 Eastern at 855-935-8255. Now, let's do another question.
Hi, Don and Tom. Thanks for taking my call. Love your show. I'm going to turn 65 this year, and about probably 3-4 years ago, I took the risk quiz, and I scored in the 60s. I'd never, in my 401k was usually always all stock. I think I had a REIT for one point. And I knew that I was 60. I knew I needed to start having bonds in the portfolio. So I ended up rebalancing. I rounded up and I did a 70% stocks, 30% bonds. So when I looked at that time, my 401k, there was a product called Stable Value, and I've heard you guys indicate that is an insurance contract, and it's been consistently paying 3%. I'm assuming that's probably the floor, the lowest. There must be something in the contract that says that's the minimal they can pay. And it's, I think ever since 3-4 years ago when I invested in it, it's always paid 3%. And it kind of worked out because in 2022, bonds did really bad. And it was just kind of, I put it in there thinking, it's guaranteed 3%. But now I realize I really need to have real bonds. And so my 401k has 3 bond options. Well, 4 if you include the Stable Value. They consider that a bond. The first one, 2 are Vanguard and 1 is PIMCO. The first one is, it's a short-term treasury. It's ticker VB And I look at the 10-year payout, and that's the lowest payout. The next one is Vanguard VICBX, and it's an intermediate corporate bond, and it's paid over 10 years. It had a little bit higher yield payout. And then the one that has the highest payout is the PIMCO, and I think it's a junk bond. It's a high yield junk bond. Its ticker is PHIYX. So I'm really looking on this 30% of my 401k for bonds. What do I pick here? Do I pick one of these, or do I split it between two or three? And I'm assuming I should get out of this stable value. Just appreciate your thoughts on what I should do here, how I should allocate for the 30% of my bond fund. All right, thank you.
Here's a quick primer on bond funds. And I think you already noticed. The lowest yield is on the safest product. Isn't that curious? The corporate bond fund is a little more risky, so the yields are higher. And then the junk bond fund, the high yield, is really risky and has ridiculously high yields. However, the junk bond fund, at least junk bond funds in the past, have tended to perform more like stocks without nearly the reward. They're scary, they're volatile, they can be very dangerous, and they defeat the purpose of buying bonds. The reason for bonds in a portfolio is not yield. It is reduced volatility. Now, you get almost no volatility through the stable value, which means if I was going to do anything, if you want really low volatility, I would maybe keep the stable value. It doesn't pay well, but it's really, really safe, or pretty darn safe. And then just get the Vanguard Total Bond Index, which in a mutual fund is VBTLX. And that will give you the higher yields of some corporates and the higher safety of some treasuries, and a yield that currently exceeds that of the stable value fund, at least based on what you told me. So that's the route I would take. And don't think too much about this. Bonds should be purchased very simply, and do not buy that PIMCO fund. The expenses on that thing are over 0.5% per year, whereas the Vanguard Bond Fund, in fact, let me look. I haven't looked at the VBTLX lately. Okay, yeah, the PIMCO is 0.55%, and the Vanguard Total Bond Index is 0.05%, or 10 times cheaper, or the PIMCO's 10 times more expensive, 1/10 of the expense. So again, don't overthink it. Thanks for the call. Thanks for the question. And let's grab another one.
Hi, this is Glenda from Minnesota. My question is, if I sell my house, my primary residence, for less than what I paid for it, are there any taxes that will need to be paid on that? Thank you.
Well, that was so short, we'll get a bonus question. Yeah, I'm going to throw a bonus question in today. No taxes. Nothing. Nothing. Not a thing. You don't get a tax break, but you don't pay any. There's no taxes, but I can't believe you're selling a piece of real estate for less than you paid for it pretty much anywhere in the country. But yeah, if that's the case, nope, you don't pay any taxes. No taxable event, period. Thank you so much for that short and sweet question. And now, here's another. Well, I don't know if it's short and sweet, but here's another question.
Hi, fellas. Mike here. I am 80 years old, a widower. I have $2 million in assets, including property, an IRA, and a Roth IRA. I have two sons, each in their mid-50s, who will each inherit half of my estate when I die. One son will be able to manage a large inheritance very well. The second son will not. I plan to establish a springing trust for the second son and arrange for him to receive monthly stipend from the trust. I am thinking that his portion of the inheritance should be invested 70% in VT, 20% in AVUV, and 10% and BNDW. The trustee could be responsible for rebalancing the percentages annually. What do you think? I've been listening to your podcast since hearing about Talking Real Money on Clark Howard's podcast. Safe travels, Don. Thanks.
Well, thank you for the kind thoughts. And so far, so good. I only have a couple of days left on the road trip. I think I love the idea of the springing trust, so that you've got somebody who is taking care of those stipends, whatever those might be. The problem is your portfolio is very, very aggressive. And should we go into a protracted downturn in the stock markets, even though you've got global diversification, we still could have a global meltdown for a while. You are really focused on stocks. And plus, I don't get why BNDW, which is the World Fund instead of BND, but that's okay. I would probably weight the portfolio a little bit more conservatively if I was doing it for a kid. I wouldn't be any more than 50% in VT, maybe doing the 20 in AVUV and then 30 in bonds, because it really depends on again, the devil's always in the details, on the particulars of the portfolio and what percentage of the portfolio those checks amount to. But if they're in the 4% range, then I think I wouldn't want to have 100% portfolio just because of the possible frightful drawdown that could occur in a protracted declining market. But I love the basics of what you're doing. The diversification is good, except I think you need more bonds. But otherwise, you're okay. Thank you so much. Let's grab another question.
Hey, Tom and Don, or Don, Tom. Not sure which sounds better. Tom and Don works. This is Michael in Houston. Really appreciate you guys for the show, everything you guys do. Really fun to listen to, but also entertaining and informative, which I think is good. Recently on a podcast, I heard you guys talk a lot about people that overthink things. This is probably in that category, but let's just see. There's this conversation going on about IRA contributions and whether they should be, lump sum first of the year. So I'm at the 7,000 limit every year. So whether on January 2nd, for example, I drop in $7,000 into my account, or do a monthly. I think it's like $584. Just first of the month I contribute that way instead. Seems like it doesn't super matter, but there's some really vocal people saying like, all of these studies have come out that say the lump sum thing works better in the long run, but they can never actually produce that information. Like they don't cite those studies. They don't show them, say, here's where that's been proven, et cetera. So just wanted to get some clarity as to whether it actually matters, and then also, I guess moving forward, like how logistically to make that happen, right? So is the idea that you would set aside cash in like a high yield savings over the course of the year on, January 1st or January 2nd of the following year, immediately make a lump sum and then like contribute to the high yield savings, or like what is the mechanism there? I guess the thing that I was getting hung up on is like, okay, if I'm keeping cash just super liquid in like a bank account or something, or even in a high yield savings account, to wait until the start of next year, instead of like I could have been investing the whole time. It just, again, could be overthinking it, but if there's actually any real difference there, it'd be great to know. Thanks again.
The wonders of being born with a big brain, of being of a big brain species. We do overthink. We overthink. You overthought. You're overthinking, but your thinking is really interesting, because I'm a big believer if you have the money sitting there that you lump sum it into whatever you're investing in. You don't want to just store it up for, I'm going to wait until then to invest it. Why not be investing it all along? And you threw that wrinkle in at the end. You see, if you're saving it in the prior year to making the IRA contribution, and you're putting it in a money market to make the lump sum, well, then that defeats the whole idea. You might as well be buying an ETF in your taxable accounts. And then in the next year, instead of saving it monthly, you just put it into the IRA. See what I'm saying? If like this year in 2024, you're saving the 500 and some odd bucks a month for next year's IRA contribution, well, that seems silly. Just invest it. And then starting in January, that money you were putting away for the next one in 2026. See, I'm overthinking this and I'm getting confused. You don't hold it. In other words, whatever you have to invest, invest. And then as you earn money, that's the only reason dollar cost averaging makes sense, is because it's how we make money. We make money on a dollar cost averaging basis. And you mentioned that. Just put it somewhere where it has the best long-term potential for you, as long as you understand the volatility of markets. And when you're in the accumulation phase, downward volatility is your very best friend. When the market goes down, accumulators should cheer, not frown. Ooh, that was very poetic. And you should be, if you could find some more money, put some more in when it's down. You should never get upset when it's down when you're in your 20s or 30s or even 40s or 50s, as long as you're still accumulating. Because you want it to be down when you're accumulating. You want it to be up when you're taking it out. Too bad we can't make it work that way. Thank you all for the questions. It's my favorite episode of the week. I really do love it. And if you want to ask us questions in person, Tom and I will be together on Saturdays at 855-935-TALK from 3 to 5 Eastern, noon to 2 Pacific, starting, well, I think like tomorrow. We'll be together. I'll be in Spokane at a dairy farm, and Tom will be in Seattle. And then we'll be in Chelan. I don't know. It gets very confusing, but thanks for kind of following along and keeping up with us. If you want to learn more about anything we do, just go to talkingrealmoney.com. If you want to spend a little time with a fee-only 100% fiduciary advisor without paying the fee, we do that. We've been doing that for over a decade, giving you access to really good advisors who can help you with the smaller questions, or take a look and see if you're on track, or if you, how much you're paying for your portfolio. We can tell you a lot of stuff, and we'll do it for nothing with no obligation. Now, if you want to hire us, we'll charge you, because that's our business. Thanks for being there. Take good care of yourselves, and I'll be talking to you soon. Tell a friend or two or 1,000. Talking real money almost every day. I'm Don McDonald.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.